Thomas will stand up when there's a minute left to let me know there's a minute left in the presentation time. So with that, I will turn it over to you guys. Good luck.
Hello everyone, we are at the University of Richmond and we are so excited to share with you our investment recommendation of Booking Holdings Incorporated. My name is Lucy Rand.
I'm Andrew Park.
I'm Ryan Petronella. I'm Sam Goldblatt. And I'm Ben Raymond.
So today we're recommending a buy rating with a 12-month price target of $6,240.79, which from today's price of around $4,500 implies a 30% premium. We're able to give such a large premium due to three key drivers on the right. Just to give a little overview. Okay, to start with the business overview, what is Booking Holdings? Booking Holdings is the world's largest online travel company that helps people book hotel rooms, flights, and restaurant reservations through these key brands that it owns in its diverse portfolio. And what makes this company so strong is its all-in-one approach where a person is able to book all parts of their travel from a hotel room to a dinner reservation, which gives it a competitive advantage because it's hard for competitors to match that all-in-one. And it also allows customers to keep coming back. The company also has a notable ESG score and strong management team with deep industry knowledge. And here we're just showing how the company's been recovering since COVID and it's had strong, steady revenues and bookings since COVID. And here we're noting the company's strong global presence with its key brands having headquarters all across the world from US to Europe to Singapore, which just shows its dominance globally.
Now here comes the most important question. Why does Booking Holdings present such a compelling investment opportunity? Our thesis consists of three main factors. First and foremost is the dominance in Europe. When we talk about how this goes, because 80% of the market shares in Europe, Booking Holdings is just undisputedly the leader in the region. And why does it have such an unshakable position? Simply because unlike the US, hotel giants like Marriott, Hilton, they push direct bookings. But for this case, in Europe, independent hotels has a much bigger presence. And that's why they need Booking Holdings for visibility and occupancy. This gives Booking Holdings such amazing pricing strategy. And it can dictate market terms. Basically, no competitors can replicate such thing. Second of all, which is one of the unappreciated catalysts, is the shift in the revenue model from agency to merchant. And to clarify, agency model is basically users book to hotels and commission fee goes to Booking Holdings. Booking Holdings sort of serve as a middleman. And the hotels would pay Booking Holdings after the stay is completed. But for the merchant model, the Booking Holdings process payments up straight ahead. So cash is received up front for however time they want it, and they only have to pay the hotels when the guests check in. So that gives sort of a flow advantage, basically having the cash, very flexible payment, and also it could bundle in a lot of other services. In other words, diversifying the revenue. You can bundle in car rentals, insurance, and that is amazing. Now, if Europe is the fortress for Booking Holdings, then the next battlefield for Booking Holdings is Asia. Because Asia, there is a surge in online hotel distributions. What it means is more and more hotels are swifting away from traditional travel agencies and looking for online platforms, and that's when Booking Holdings take place. Also, mid-sized small hotels in Asia doesn't have, again, the visibility, occupancy, so they rely on bookings to do that. And if you can see here, Asia, and especially through Agoda, which is a specialized brand dedicated to the Asian market, it can capture significant market share. Now, of course, investments have risks, but Booking Holdings counter those challenges by having AI and compliance investments. First and foremost, on the competitive front, we think about how Booking Holdings have partnered with entities rolling out these AI tools, travel tools, launch personalized booking AI. Features such as, Smart Filter Property Q&A gives these instant insights. And also Pagodas has been making a lot of efforts into providing compelling offerings, payment flexibility, payment options, partnering with Visa, for example, and at key destinations such as South Korea, Japan, India. This is good because it poses a great position against other competitors in the region, such as Trip.com or Chase Travel. In terms of regulations, it has been actively collaborating with EU, with European Commission to meet these requirements, and notably, latestly, it has been able to resolve an Italian antitrust, and showing these moves to comply with all of these investments.
Yeah, so now I'm going to talk about the connected trip. So basically what the goal is with the connected trip is to give the user, one place to not only just book their hotel, but also their car rental, airplane tickets, dinner reservations. So right now, each of the different segments, they all have their own AI. So the goal is to kind of combine that into one space so that they'll just be able to book everything through there. And not only just is it going to be there at the very beginning, but it's going to act as a travel agent and be there with you along the trip. For example, if there's bad weather, it'll recommend to switch different reservations around and stuff like that.
So diving right into the financial analysis, you can see here that Booking has extremely strong organic revenue growth, and this revenue growth has shown in the forecast $27 billion, up from $21 billion in 2023. That forecast is a 21% increase since 2023, and that allows for them to have a really extremely high adjusted EBITDA as well. And so that disciplined financial management will allow for really strong focus on shareholder returns. And so here we have a kind of graph of their shares outstanding, and the reason for this is because they've been buying back shares since 2017. So they have decreased their amount of shares by around 21% since then. And they also just recently announced a new buyback program for $20 billion additional dollars. So they will, by 2026, hopefully achieve this goal, and in addition to the previous one in 2022, reach $27 billion more in buybacks. And so with AI integration, we can see that in the graph for 2023, it kind of increases their percent of cost of revenue for their personnel and IT. The reason for this is because they were integrating this AI platform to kind of decrease their costs when it comes to these, so they can kind of lay off some potential customer service representatives. And so we see that drops back down in 2024, especially compared to their 2022 numbers. And finally, and their booking, their cash balance, it's really strong. They're right in line with their long-term debt amounts, so they can really pay off this debt extremely well if they need to be.
Starting off in the valuation section, just want to walk through some of the sensitivities we've worked on in terms of giving that perspective in our model. So in the base case, we're really going off of the current resilient data that we're seeing in consumer sentiment and just projecting it out with what management has been guiding for in terms of growth in key growth areas like Asia as well as Europe. In the bear case, we're seeing weaker consumer sentiment as inflationary concerns take a hold just because of whatever it may be, Trump's tariffs. And that was going to make people a bit more cautious about how they're spending their dollar. In the bull case, we're seeing that won't be that much of a headwind. They're going to see continued tailwinds from COVID recovery and more people going on trips. That takes us to seeing our top line as well as our margins here, just to see exactly what those are showing in our model, in our forecast, and how that's sensitized. The 2025 is a bit weird just because of some previous numbers that we're drawing the normalization from, but this is giving a pretty good indication of where management also guides towards.
Yeah, so now looking at bookings beta, we calculated the 75th percentile levered beta using the peer group shown on the right, which got us a beta very similar to their observed beta. In addition, we can see that their WACC is very competitive with their competitors. Then using that 75th percentile levered beta, we got the cost of equity, and then on the right, we can see that bookings debt to equity ratio is very competitive with its competitors again, and also that they have very good debt management.
Moving on from more of the intrinsic value, we're looking at some of the relative valuation metrics as well, with competitors as well as exit itself. First, right here, you can see that we're seeing like there's an implied undervaluation of booking, just another signal that we could be finding this company at a good time where their earnings are being priced less than their competitors. If you look at their 5-year historical trailing average for their forward P as well, you see that same signal where they're trading below their historical 5-year and heading towards that negative standard deviation where it could be another sign of potential undervaluation. Moving into just a summary of like what we're looking at is our DCF outputs for our multiple as well as perpetuity growth, showing that there's heavy upside with minimal downside, a very attractive risk to reward profile. And when we go to our valuation summary, just want to point out that we're weighting the bear case much more heavily than the bull case, just because we see a lot of headwinds ahead, that there's just more uncertainty around the market. That brings us to our $6,200 price target with around a 30% premium, with our focus on our 3 main investment thesis spots. Thank you.
Does anyone have any questions?
Yeah, I have a. Do you know what their intention is as far as stock repurchases go? Where are they going to stop? Are they going to, at the rate they're going, they could be a private company in 4 or 5 years.
They're definitely, like, every year they seemingly decrease about, like, between, like, 15% every 2 years. So if this continues in the future, I think they definitely focus on. Also, another thing is, with their share price being so high, is because they don't really want day traders involved with their operations and kind of affecting their stock prices. So by kind of repurchasing, kind of helping to drive their share price up a little bit more, it kind of avoids that threat as well.
Yeah, absolutely. And in addition to that, this is a 12 to I believe 18-month hold period. So I guess at least in that scheme of things, that we see that with the 2 additional announced share repurchase plans that they're doing, that falls right in a good timeline of being able to realize a lot of those appreciative effects on stock price because they're buying back so much of the next couple quarters.
They also just have enough cash on hand to buy the back, so I think it's just to reassure shareholders and make them confident in the stock.
So, going back to revenue generation, walk me through how they generate revenue. In other words, if you're thinking about modeling this out on your income statement, and you've got a second tab that is the waterfall of all the things that generate revenue, help me understand where does every dollar of revenue come from?
Yeah, absolutely. I can help you, at least in terms of like how we thought about the revenue build. It was broken down into looking at gross bookings numbers, essentially, which is just how much in dollar amounts are customers or users of the app booking in dollar amounts. And then from that amount, we are assuming a percentage of take rates. As you can see, I believe it's 1% down. Because it's this one here. A take rate is essentially how much they're making off of that gross. That's essentially their commission that they're making off of connecting travel service providers to customers, and that's being assumed to be 14.1% or 1.5%. But that's in the line with like how they've been growing in the past. And essentially that flows out into 2 different models where they make money, where it's agency revenues versus merchant revenues. One is a bit more profitable, which is merchant, and they also have a small 5% segment of revenue which comes from ad spend or advertising, because they have a meta search function in Kayak that also as well as OpenTable, where they are mainly earning revenues off of just placement of ads. So that's how they kind of flows down to like that total revenue number at least.
Just to add to that, there's a graph in the beginning that shows sort of the breakdowns of the revenue. So down below there, as Andrew mentioned, is the agency and the merchant, and also a small portion of advertising and other revenues. But definitely we can see here that when you're shifting from the agency to the merchant model, there's been a greater take rate. And the numbers actually in 2021 and 2022 giving back or staying back to the number before COVID. So it's a great recovery. And yeah, it's represented a big increase compared to 2022.
Yeah, they've been trying to expand their merchant revenues because basically the difference between agency and merchant is merchant, they buy up the hotel rooms and then they sell them to consumers, so then they have the pricing power. And so they would rather have more revenues from merchant than agency, where they just take a fee and everything.
And that's also like especially what they're trying to do in Asia right now, because right now it's a lot of agency bookings, so they're really trying to change that to merchant bookings so they have more price control and yeah, more profit.
I guess my question, Paul asked a little bit, and you sort of answered it. You know, they seem to be pushing towards the merchant model. You said the merchant over agency. Merchant has higher margins than the agency. So have they been focused on trying to increase the merchant specifically?
Yeah, that's definitely it. I'd say how they grew in the past was by doing the agency model, just because that helps them gain market share,
Right.
Because it's more beneficial for service providers. But now that they've gained such a dominant position in Europe, they're trying to capitalize on that and create a shift towards the merchant model, which everybody else is already using. So they're just kind of converting this industry standard after capturing all that market share.
Okay, like in 1 minute or less, and help me understand. So the merchant model, they're going out and buying hotel rooms and then reselling those hotel rooms?
Essentially, yes.
So they're arguing the price on the hotel room?
Essentially, yes.
So doesn't that pose risk to them if those hotel rooms don't get taken up?
Basically, so what you have mentioned is the connected trip feature. So when they buy in these hotel inventories, right, they could be filling up occupancy by pulling up other features as well, like flights, and then places to visit, and then also car rentals, insurance, and sort of offset those. Not to say that occupancy is getting a great deal problem. So the connected trip sort of makes sense if you sort of offset those.
Yeah, it kind of just lets them bundle, everything together.
Time, so yeah, okay, thank you.